A couple I spoke with recently had been giving around $10,000 a year to charity straight from their checking account. But what they didn't realize was that there were thousands of dollars in potential tax savings that they were just leaving on the table. Now, if you're charitably inclined, have an IRA and you're eligible, there may be a smarter way to give and lower your tax bill through something called a qualified charitable distribution. Hi, I'm Jordan Lehman, founder and financial planner at True Wealth Retirement Partners, and every day I'm helping my clients create steady retirement income, invest smarter, and pay less in taxes. And I want to share what's working for them so that you can retire with confidence too. And today I'll show you how QCDs work, how they compare to cash giving, and actually walk you through a real world case study showing the potential tax savings at 10, 20, or $30,000 in annual charitable giving for our example client. A qualified charitable distribution, or QCD, is a way to give money directly from your IRA to a qualified charity. Now, what's the big deal? That money never counts as taxable income. That's right. As long as you're over, get this, 70 and a half, you can donate up to $100,000 per year directly from your IRA to charity and avoid paying income tax on that amount. And this is where it gets awesome. This distribution can count towards your required minimum distributions for the year. So why does that matter? Well, two reasons. One, this could save you serious money in taxes versus giving in cash. And we'll compare the two side by side in just a second. But number two, once RMDs kick in, you have to pull money out of your IRA, whether you want to or not. And that triggers taxes. With a QCD, you satisfy your RMD, accomplish your giving goal, and you avoid ever paying taxes on that amount. So do this right, and you could reduce your taxable income, potentially having impacts on your Medicare premiums or even Social Security taxes. So instead of giving from your checking account, you're giving from your IRA via a QCD in a smarter, tax savvier way. So let's jump into a side by side comparison cash versus QCD giving for 2025. Which one in our example saves them the most in taxes and why? Okay, so before we jump into the side by side, we have to know some of the variables. So feel free, pause on this screen here. You can take a look. Here's some of the highlights. They're already retired, both age 70. They are spending both from a taxable investment account and a $66,000 combined gross Social Security benefit. They're spending about $65,000 a year after taxes, and they're taking the standard deduction. Now, there's more you can go through here, but let's jump up to the actual side by side comparison. So here's our example, giving $10,000 in cash versus a QCD. Now I'll add to the assumptions down below. We're assuming they do a $30,000 Roth conversion as well. So stick with me. Even if your scenario is slightly different, the same principle can apply for you. So this is the cash giving scenario. Their total income before deductions is $80,825. They take the standard deduction, which in 2025 is $30,000 for seniors. There's an increase even over that. So we see that difference netted out here for a total then income tax on this amount of, this is federal by the way, $47.58. Now, what about the QCD? Remember, they had to take the cash distribution from their IRA and then give it to charity. Well, that was a taxable event. Well, what if with the QCDs, they take from the IRA, but do it via a QCD and not pay taxes on that draw? There's actually multiple things happening here. Well, their total income is lower. By how much? Well, it's lower by the $10,000 that they gave via a QCD instead of a taxable IRA withdrawal, but it's also lower by the difference between their taxable Social Security. Now, this is some detail maybe for another video, but because their total taxable income was lower, the amount of their Social Security benefit that is counted as taxable, again, separate conversation, was also lower. So they benefited not just in the tax savings on the $10,000 difference, they benefited because less of their Social Security became taxable because they had less gross income. So their adjusted gross income, in this case, 62,325. Again, take the standard deduction. And now their income tax in this scenario is 2538. So in 2025, for this example client, again, they're living off Social Security, they're doing a little bit of conversions, pulling some from a taxable account, very typical scenario. They save over $2,000 in federal taxes for giving via QCDs. So, before we dive into the potential lifetime tax savings for this client, I just want to do a quick note. QCDs are one of many ways to give to charity and save big on taxes. So, if you'd like help finding other tax saving opportunities based on your plan, go ahead, click the link in the description for a free Tax Smart retirement assessment. I would love to help. So we saw the tax savings in 1 year for our example client. What if we project this over the life of their plan? Remember, in the assumptions, we have them living to age 95. Well, what does this look like? Well, at $10,000 of annual giving, cash versus QCDs, if you run the difference out, you can see that QCDs would be estimated to save this client over $43,000 in their lifetime. Now, get this, that $43,000 of savings, they could give more, they could keep invested and have that savings compound more over time. So the actual difference in their nest eggs at the end is greater than this because the assumption is that this value continues to compound rather than get pushed to the federal government. So that's $10,000 in annual giving. What about $20,000 in annual giving? Well, this client would stand to save almost over $54,000 in federal taxes, and $30,000 stand to save over $65,000 in federal taxes as an estimate over their lifetime. Now, we know proactive tax planning, tax laws change, things change, and we would be proactive year over year looking at this and determining the best giving strategy based on what's true then. And directionally, the QCDs here would be a tremendous tax savings opportunity for a client just like this. So here's the bottom line. Giving through a QCD isn't just about saving taxes. It's about being intentional with your money. You're supporting causes you care about while keeping more of your income working for you. So if you're giving, make it count. And if you're not sure how this fits into your retirement plan, it might be time for a second look. So thanks for watching. And hey, if this helped you, give it a thumbs up or share it with someone you think might want to know this. And we'll see you in the next one.